We got some massive news for stock market investors as the Bureau of Labor Statistics in the United States reported the monthly jobs data. The monthly jobs data always has huge implications for stock market investors because it leads to cascading figures in terms of how much money people have to spend, and then in terms of the central bank's policy in raising or decreasing interest rates. So it always is a huge deal for stock market investors, and I'm going to explain to you in this video why that's the case. I'm also going to explain what I'm doing with my portfolio, with my investing strategy as a result of these numbers that came out today, what changes I'm making, what I'm preparing to do, and my investing strategy based on the numbers that I'm seeing. So I'll do all that in this relatively short video. So let's jump right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the Bureau of Labor Statistics reported that total non-farm payroll employment changed little in August, with 22,000 jobs being added. And if you look at the longer term numbers, you can see the unemployment rate has been rising steadily since August of 2023, when the unemployment rate in the US was around 3.7%. Now, with the most latest figures, the unemployment rate is at 4.3%. And that's not even accounting for the number of people that are employed in jobs that are part-time and would prefer to be in jobs that are full-time, and also workers that have been discouraged from looking for work and are no longer searching for work. Furthermore, if you look at the jobs data in the previous 4 months, if we look at May, June, July, and August, the revisions that were made in today's employment report, which I'll share with you a little later, showed that in June there was actually job losses instead of gains, the first such loss in a monthly jobs number, going all the way back near the pandemic times. And then May's jobs figures were not all that strong either. So in the previous 4 months, we've seen a bleak employment picture. And this is something I forecasted. If you recall, I made several videos following President Donald Trump's trade policy, and I indicated how that would lead to worldwide economic slowdown. And it's not just because of the higher percentages of tariffs that were implemented, it's also all of the uncertainty. Businesses don't know what to do. They don't have the numbers to make the decisions, and the numbers are changing so frequently. Businesses are just, holding off and saying, let's just pause. Let's just wait for all of this to settle down until we make any big decisions, because right now things are moving around so quickly and by such large amounts that it doesn't make sense for us to make any big decisions like moving our manufacturing facility from one country to another, or changing our product profile, removing a product, expanding to new product categories. Those are all big decisions, and business owners are not making those decisions. They're delaying those decisions and just waiting for more information before they can decide, because right now there's too much uncertainty. So there was further indication of a macroeconomic slowdown if we look deeper into the numbers, right? The headline number was not very strong at 22,000, but if we look deeper into the numbers, it looks even worse. And it's because most of the jobs that were added were not related to economic strength. In fact, it's the opposite. So in August, you had healthcare adding 31,000 jobs, and that was below the average monthly gain of 42,000 over the prior 12 months. And of course, healthcare jobs do not have anything to do with macroeconomic growth. In fact, it's sometimes the opposite. Slowdown in economic activity leads people to have poorer health outcomes because they feel stressed, and the stress causes other kinds of poor health outcomes, and they seek healthcare more often than they otherwise would. Furthermore, employment in social assistance added 16,000 jobs. Of course, social assistance is the opposite of a strong economy. If the economy is growing robustly and people have work and employment and incomes are increasing, they're not seeking social assistance. So it's the opposite that's happening right now. economic growth is slowing down, and it's leading more people to look for social assistance. Of course, this is not only are the jobs numbers slowing down, but at the same time, you have an increase in prices. So people going out to buy the usual things that they buy to sustain themselves for the week and for the month are finding that they have to pay higher prices for rent, for transportation, for food, for almost everything. People are paying higher prices and their job prospects are diminishing. Additionally, the federal government is shedding jobs. Federal government employment continued to decline in August. 15,000 jobs were cut, and this federal government employment is down by 97,000 since reaching a peak in January. This in the short term might be a headwind to economic growth because these folks that are losing their jobs who were working for the government, they're not going to go out and buy a car. They're not going to go out and eat as often outside of the home. But longer term, it should be a positive for economic growth because if the federal government is less wasteful, they won't need to tax the population by as large a margin, and lower taxes should lead to more consumers having more disposable income. And so that should be a positive longer term, even though in the near term, this will be a headwind to economic growth. So this is a figure I've been paying very close attention to. It's the manufacturing jobs number, because I wanted to see if manufacturing jobs in the United States are increasing as a result of the increase in trade barriers, right? The president said that if we are to place tariffs on businesses that are importing goods from outside the United States, then there will be huge, massive investments in the United States, more manufacturing jobs being created. That was the promise, and I've been waiting for that. And so far, we haven't seen that. Manufacturing employment in August was down by 12,000, and it's down by 78,000 for the year. So we've seen continued job losses, and this is partly contributed to by trade policy. Most U.S. businesses rely on uh, other businesses outside of the United States, even if they're manufacturing everything here, even if all of their manufacturing facilities are in the United States, they're still importing things from outside the United States. Things like machinery, inventory components, other items that they need for their own process, they could be importing from outside the United States. It's very difficult to get everything you need to make your product and service inside the United States. Almost every business relies on components and things from outside of the United States. And of course, if you're paying higher prices for those, then you're less interested in making as many products because your profit margins are shrinking and you have to rely on increasing your prices to maintain your margins. And you're not sure that you're going to be able to increase your prices because you're looking outside and you're looking at the macroeconomic picture. You're looking at the US economy not growing as quickly in terms of the number of jobs being added. And you wonder if your customers would pay higher prices for your products or if they would just stop buying your product and buy another product or just go without. So one good news from the data out of this report is that over the past 12 months, average hourly earnings have increased by 3.7%. And that's slightly above what inflation has increased by in the previous 12 months. So people's incomes have outpaced the increase in prices. And that's good news because that means their real purchasing power adjusted for inflation is increasing. So there were also revisions in previous months' employment figures, which is always the case with this monthly data. You also get revisions to previous monthly data. So with the revisions, employment in June and July combined is 21,000 jobs lower than previously reported. So not only was the current monthly job gain not enough to keep pace with the increase in population, but also there was revisions lower for the previous few months. So we are without question seeing a significant slowdown in the US economy. The number of jobs being added is declining significantly. And a couple of days ago, I reported to you that the number of job openings are also declining significantly. There's a clear trend downward in the number of job openings. And it's because what I mentioned in the beginning of the video, businesses don't know what decisions to make. They're still waiting. They're on pause. They're not opening new jobs. When people quit, they're not replacing them. When people retire, they're not replacing them. They're not adding new products. They're not buying new things. They're not making expansions. They're not adding the second restaurant location. They're just kind of waiting, tightening their belt, and seeing what happens with all of these changes in policy that is expected to create a decrease in economic activity. So another thing that's likely to happen now as a result of this clear slowdown in the US economy is the central bank in the United States is very likely to start cutting interest rates when they next meet in September, and they're likely to signal to investors and consumers that they will continue lowering interest rates. Lowering interest rates creates a stimulus to the US economy, because when you go out to buy things like a car and a house, your monthly payment is dependent on the interest rate. And so if the interest rate is lower, your monthly payment will be lower and you'll be more interested in buying that car or that house. And of course, if you buy a car, you're going to buy insurance, you're going to have to fill up gas, you might buy accessories for your car, your salesman will earn a commission, the dealership will make a sale, and it creates all this economic activity, which could create ripple effects throughout the economy and creating growth and helping the economy grow despite these trade policies that are creating headwinds for the US economy. Okay, so what am I doing with my portfolio? Of course, I anticipated these trends when the trade policy was announced in early April. So I've been prepared for this kind of macroeconomic slowdown. I've been talking about this for several months. So if you've been watching my channel, you're not surprised with this slowdown in the US economy. I also said that I don't expect this slowdown to lead to a huge recession. I don't think that's going to be the case. Businesses, even though we're seeing slower job gains, businesses have been hesitant to let go of people. And let me be more clear. Businesses, consumer-facing businesses, have been more hesitant to let go of people. Corporate jobs and corporate roles, there's been a lot of cuts in those areas, right? If you work as, let's say, a financial analyst at Walmart, your job could be at risk. But if you work inside a Walmart store, or if you work inside an Amazon warehouse, or if you work in at Domino's as a delivery driver, your job is probably not at risk. Those companies are still reporting to investors that they're desperate to find new workers. And that's where the majority of employment lies, is in those consumer-facing roles, and increasingly so. So as long as individuals are not picky, they're still finding jobs in those areas. It's the corporate roles, it's the roles inside companies like Alphabet and Meta Platforms and others where jobs have been harder to get, not only because they've anticipated this slowdown, but also because artificial intelligence is supporting more workers and management teams, and so they can do more with fewer people. So the central bank is likely to lower interest rates, which makes it more attractive to own stocks because the cost of capital for businesses is lower, and also the opportunity cost for investors is lower, right? If previously you could invest in government bonds that would pay you, let's say in the money market account, you can get 5%. And after the Federal Reserve lowers interest rates, now in a money market account, you can only get 3.5%. You're less interested in putting money in the money market account and more interested in putting money in a stock market account, in an equity account, in stocks that could deliver better gains than just 2 or 3 or 4%. So I'm preparing my portfolio to add more stocks. I like to see better valuations and interest rates decreasing. I would like to see a stabilization of the jobs numbers. I'm not thrilled with how few jobs are being added and all of the uncertainty for business owners as it relates to trade policy. I would like to see more certainty, even if the numbers are higher, even if businesses are forced to pay these higher tariffs, at least knowing what they will be without so many revisions will help them make decisions. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.